Price Index report of 2025 revealed that inflation remained at 2.7 in the month of December. It marks a year of gradual easing from previous highs, but many consumers still are feeling price pressures. Joining me to talk about that disconnect is the Vice President of Wilsey Asset Management, Mr. Chase Wilsey. Chase, welcome back to the big show.
Thanks for having me. I was good to be here.
2.7, the wheelhouse is 2.0, right?
The wheelhouse is 2.0, and I mean,
Why?
there's so many different numbers. Well, actually, the Fed set this number back in 2012. Now, why 2%? I can't tell you. I think the concept is it's just enough of price increases, but not too much of inflation, right? You don't want runaway prices, but you also don't want deflation either. So it's, I think a healthy level of inflation is the idea behind the 2% target.
All right, we're looking at the overall inflation rate of 2025. What does that graph tell you?
Well, I mean, the big thing that you see is, we kind of started the year a little bit higher at 3%, and we didn't get a whole lot of progress, but we did see a decline as the year progressed. And the big thing I like to keep pointing out is shelter inflation, the cost of homes. The way they calculate that, it's not like the price of homes. They look at something called owner's equivalent rent, which is basically people saying, I think I could rent my house out for this, or rental prices. That has come down substantially. Back a few years ago, it peaked around 8%, and the most recent report is 3.2%. But this is a very lagging indicator in my mind. We should see more progress on shelter inflation as we progress through 2026. I believe that will be a big benefit to the overall inflation numbers because it's about a third of headline CPI and around 40% of core CPI.
That graph also says to me, and I know this is a little slightly off the path here, I don't know if we can throw it back up, but a lot of people sat on that sofa and told us that the tariffs were going to crash, inflation was going to soar, and it was going to crash the economy. Au contraire.
Yeah, I think tariffs, I don't want to say there wasn't any price impact. I'd be naive to believe that. But it didn't really destroy inflation. It didn't have the major impact that some pundits were leading us to believe. I mean, I look at apparel prices. Year over year, it was up 0.6%. New vehicles, I believe, was up somewhere around 0.3% year over year. Those would have been, in my mind, two of the biggest areas impacted by the tariffs due to the supply chain situation.
All right, and we're looking at that graph because here's where the disconnect comes in. You'll have Scott Bessent and White House administration saying, hey, we're getting this under control. It's going slowly, but we're getting this under control. The economy is really, really roaring, and it's going to roar even more in this new year. Joe Blow at home is saying, hey, it's still, I still only have 25 bucks in my pocket after I pay my bills. And I think the president's polling numbers are reflective of that disconnect because people are saying, hey, no, it's not. We're still struggling out here. But it has more to do with housing?
Well, I think the big thing is we have seen prices increase, and the problem is you're not going to have deflation. As I said, prices will not decline, and there's going to be some areas, right? Like egg prices, for example, they went way up and then they went way down. Right. You're going to have certain areas of the economy where prices decline, but an overall decline in inflation, that is not a healthy situation to be in. So I think the problem is we had such big inflation for several years under the previous administration, and now people are wanting prices to go back to 2019 levels. And to be blunt, that is not going to happen. You need to look at the price change rather than the absolute price.
Or the other way to attack that would be to have your take-home check grow, would it not?
Exactly, yeah. You want to look at real wages and how those are growing over time, because that price component and what you're spending, as I said, is not going to change. But if we can get real wages to increase, that's going to be a benefit to the average consumer.
But how do you do that in the face of AI and jobs being basically consolidated and lost?
Well, I think the big thing you have to look at is, number one, how can you prove your worth to the company? And if you can use AI to become more efficient and produce value for companies, you should be able to negotiate a higher pay scale. And the thing that I look at with AI too is, yes, it is going to make certain jobs maybe obsolete, but also too, there will be new jobs created that we never thought of. One I always talk about with social media as an example. Got married, several years ago now, but they have nowadays somebody that will follow you around on posts on social media. That wasn't a job, 15, 20 years ago. And I can't even tell you what jobs will be created from AI maybe 5 to 10 years from now, but I believe there will be new jobs. So don't just look at the negative side of AI job replacement.
We have to wrap this up. When we do this interview a year from now, what's the inflation rate going to be?
I do think we will be pushing closer to that 2% level. I don't think we'll be at target, but I do believe we might be around 2.2, 2.3 as a good positive side.
Up next on Good Morning, thank you, Chase. Have a great day, okay? Up next on Good Morning San Diego, newly proposed bills looking to tax vacation homes thousands of dollars. When we return, we'll take a